After Venezuela and Saudi Arabia, Canada is home to the world's third largest oil reserve. But when it comes to heavy crude, the kind that U.S. refineries rely on, Canada is second, with the only other significant source globally coming from Russia.
A U.S. military operation in Venezuela has captured President Nicolás Maduro, and Donald Trump now plans to redirect Venezuelan crude exports toward American refineries, and this development has sent shockwaves through North American energy markets. While Canada oil sector, which is heavily reliant on U.S. Gulf Coast refineries, now faces immediate uncertainty, and this move could reshape heavy crude trading patterns across the continent. Venezuela holds the world's largest proven oil reserves, and despite years of production decline under sanctions and economic collapse, its heavy crude remains valuable to specialized refineries, and U.S. Gulf Coast facilities were originally designed to process Venezuelan barrels. While the Trump administration is now moving to lift sanctions selectively and potentially control Venezuelan oil sales, with the stated goal of boosting U.S. refinery operations and expanding American energy dominance. Canadian oil producers are watching with concern as Canada exports significant volumes of heavy crude to the same U.S. refineries that historically processed Venezuelan oil, and early market reactions already show Canadian energy stocks declining as traders anticipate renewed competition. While if Venezuelan barrels flood back into North American markets, Canadian producers could face reduced demand and serious pricing pressure. The Canadian oil industry depends on access to U.S. refining capacity, with roughly 97% of Canada crude exports going to the United States, and most of this volume consists of heavy oil from Alberta oil sands, and these barrels compete directly with Venezuelan heavy crude in terms of refining specifications, while U.S. refineries have the infrastructure to switch between Canadian and Venezuelan supply based purely on price and availability. According to Reuters, Venezuelan oil would boost U.S. refiners but hurt Canadian producers, and the report notes that renewed Venezuelan exports could displace Canadian barrels quickly, while U.S. buyers would gain leverage to demand lower prices from Canadian suppliers, and this dynamic could force Canadian producers into deeper discounts or reduced market share. The Washington Post reported that Donald Trump actions include potential subsidies for American oil firms operating in Venezuela, and if U.S. taxpayer funds support Venezuelan crude extraction and export, then Canadian producers face an uneven playing field where the competitive advantage shifts toward Venezuelan supply backed by American government resources. While Canadian industry officials have not publicly addressed this subsidy scenario in detail, analysts already see it as a long-term risk factor. Canadian government officials maintain that the country oil will remain competitive, and they cite stable governance, lower political risk, and established infrastructure as advantages. However, market analysts argue that pricing ultimately determines buyer decisions, and if Venezuelan oil becomes available at lower costs, refineries will prioritize economics over political considerations. Heavy crude markets are already volatile as global demand patterns have shifted in recent years due to refinery upgrades and changing product slates, while the return of Venezuelan barrels adds another variable to an already unpredictable environment, and Canadian producers were already managing narrow profit margins before this development, meaning additional competition could squeeze revenues even further. Regional economic impacts could be significant because Alberta economy relies heavily on oil production, and employment tax revenues and investment flows all depend on stable crude prices and consistent export volumes, while if Canadian oil faces sustained pricing pressure or market displacement, provincial budgets and labor markets could suffer, with other oil-producing regions in Canada facing similar exposure. Geopolitical dimensions add even more complexity because Donald Trump military intervention in Venezuela and subsequent control over oil exports challenges established international norms, and energy alliances that Canada assumed were stable may now require reassessment, as the U.S. approach to Venezuelan oil suggests a willingness to prioritize domestic energy goals over traditional partnerships. Some Canadian policymakers worry about becoming a secondary supplier in North American energy markets, and if the U.S. secures Venezuelan production as a controlled source, Canada's strategic importance diminishes, which could affect future infrastructure projects, pipeline approvals, and broader energy policy coordination between the two countries. The timeline for Venezuelan oil reaching markets remains unclear because production capacity needs restoration after years of underinvestment, while refinery logistics and shipping arrangements still require organization, however, even modest. Volumes of Venezuelan crude could impact Canadian pricing since U.S. refiners have already demonstrated their capacity to blend multiple heavy crude sources based on availability and cost. Market observers note that Canadian producers lack immediate alternatives because pipeline capacity to reach other markets remains limited, and expanding export options would require years of infrastructure development and regulatory protected approvals, meaning that in the short term, Canadian oil must compete for U.S. refinery access or accept deeper discounts to remain competitive. The situation highlights Canada's vulnerability to U.S. energy policy shifts because decades of integrated energy markets and cross-border trade have created dependencies that now present risks, and Donald Trump's Venezuela strategy demonstrates how quickly assumptions about energy partnerships can change, forcing Canadian industry and government officials to reassess strategies as they closely monitor developments. Venezuelan production levels before sanctions exceeded 2 million barrels per day, while current output sits below 800,000 barrels daily, and if production recovers even partially under U.S. influence, the impact on Canadian exports could be substantial because refineries processing 500,000 barrels of Canadian crude daily could shift portions of that volume to Venezuelan supply without major modifications.